The trading floor is quiet now. The voices have faded. But if you listen closely, you can still hear them. The shouts, the panic, the certainty before the fall. Greed is not a modern invention. It did not arrive with computers or smartphones or 24-hour markets. It has been there in the heart of every trade for as long as humans have exchanged one thing for another, hoping to gain more in return. And it has destroyed fortunes, toppled empires, and rewritten history more times than we can count. This is not a story about trading strategies or market indicators. This is a story about human nature, about what happens when confidence becomes arrogance, when optimism becomes delusion, when the desire for more becomes the only thing that matters. In the early 17th century, in a city of canals and merchant ships, something extraordinary happened. Amsterdam was the center of global trade. Ships arrived daily from the East Indies, carrying spices worth more than gold. Wealth flowed through the city like water through its famous waterways. And in this atmosphere of prosperity, people began to trade something unusual, something that seemed at first harmless: tulips. The flowers had arrived from Turkey decades earlier. They were exotic, beautiful, and rare. Certain varieties displayed vivid colors and intricate patterns that captivated the Dutch elite. Owning a prized tulip bulb became a status symbol. Wealthy merchants displayed them in their gardens. Artists painted them. Poets wrote about them. Then something shifted. People began to see tulips not as flowers, but as investments. A market emerged, not in shops or formal exchanges, but in taverns and homes across Amsterdam. Ordinary citizens began trading tulip bulbs they did not yet possess, making promises to deliver them months later when the bulbs could be lifted from the ground. These were contracts, futures, the first stirrings of what we now call derivatives trading. Prices began to rise. A single bulb of a rare variety could cost as much as a craftsman earned in a year, then 2 years, then 10. People sold their homes, their furniture, their land to buy into the tulip market. Blacksmiths became traders. Weavers became speculators. Everyone believed the same thing, that prices would continue to climb, that someone else would always pay more. The trading was frenzied, but it followed a pattern. Someone would buy a contract for a bulb. They would sell that contract to another buyer at a higher price before they ever had to take delivery of the actual flower. The bulb itself was almost irrelevant. What mattered was the promise, the paper, the bet, that tomorrow would bring another buyer willing to pay even more. There were warnings, a few voices of reason pointing out the madness. How could a flower be worth a fortune? What happened when people wanted their money back? What happened when spring came and someone actually had to deliver real bulbs to settle all these paper promises? But these voices were drowned out by the sound of coins changing hands and the intoxicating rhythm of easy wealth. In February of 1637, something changed. No one remembers exactly how it started. Perhaps a single auction failed. Perhaps one buyer hesitated. Perhaps someone simply asked the question out loud that everyone had been avoiding. What if no one wants to pay more? The market collapsed in days. Contracts that had been worth thousands became worthless overnight. Buyers refused to honor their agreements. Sellers could not find anyone to purchase their bulbs. Fortunes vanished like morning fog over the canals. Families were ruined. Suicides followed. The courts were overwhelmed with lawsuits that would drag on for years. The tulip mania, as it came to be known, was not just a bizarre historical curiosity. It was the first recorded speculative bubble, the first time we saw, in clear detail, how trading based purely on the expectation of rising prices could create a collective delusion, how greed, when shared by enough people, could temporarily override reason. But the Dutch learned nothing permanent from tulips, neither did anyone else. A century later, across the English Channel, another fever took hold. This time it was not flowers, but shares in a company. The South Sea Company had been granted a monopoly on trade with South America by the British Crown. The reality was that Spain controlled South America and had no intention of allowing British trade. The company made almost no profit from actual commerce. None of this mattered. What mattered was the story, the promise, the dream of vast wealth flowing from the New World. The company's directors launched an aggressive campaign to drive up the price of shares. They spread rumors of enormous profits. They offered loans so people could buy more shares, using the shares themselves as collateral. They paid dividends not from profits, but from the money new investors were putting in. It was a scheme built on air, but it worked brilliantly. Share prices soared. In the spring of 1720, shares that had been worth £100 were trading for 300. By summer, they hit 1,000. Everyone in London was talking about the South Sea Company. Members of Parliament bought shares. Ministers of the Crown bought shares. Even King George himself invested. The trading became a spectacle. Coffee houses turned into impromptu exchanges where men shouted bids and offers across crowded rooms. New companies sprang up overnight, offering shares in ventures that ranged from the improbable to the absurd. One company promised to drain the Red Sea to recover gold from the crossing of the Egyptian army. Another offered shares in a company for carrying on an undertaking of great advantage, but nobody to know what it is. People bought them all. The frenzy fed on itself. The rising prices were proof that everyone was getting rich, and if everyone was getting rich, you had to get in before you were left behind. This was the logic of the bubble. Fear of missing out became more powerful than fear of losing everything. In September of 1720, the bubble burst. The South Sea Company directors began selling their own shares, quietly at first, then desperately. The price collapsed. Within weeks, shares worth £1,000 were trading for 100, then 50, then less. The devastation was total. Aristocrats were reduced to poverty. Middle-class families lost everything. The Chancellor of the Exchequer was implicated in the fraud and fled the country. The company's directors were arrested. Their estates were seized. One committed suicide in the Tower of London. The South Sea bubble became a cautionary tale told for generations. Books were written, poems were composed, artists created satirical prints showing people as crazed gamblers. Parliament passed laws to prevent such schemes from happening again, and for a while people remembered. They were careful, they were skeptical. But memory fades, and greed does not. Fast forward to the late 20th century, to a time of computers and complex financial instruments and traders who believed they had finally figured out how to eliminate risk. Wall Street had become the center of global finance. Brilliant mathematicians and physicists had left academia to work at hedge funds and investment banks. They built models, they created algorithms, they traded derivatives so complicated that few people understood them. One fund in particular captured the imagination of the financial world: long-term capital management. Its partners included Nobel Prize winners, geniuses who had revolutionized the understanding of options pricing. They used enormous amounts of borrowed money to make bets on tiny price differences in bonds and derivatives across global markets. And for years, it worked. The fund returned profits that seemed almost magical. The trading strategy was based on mathematics and historical patterns. The assumption was that prices would always return to their normal relationships. When Russian bonds paid slightly more interest than they should relative to German bonds, the fund would bet that this gap would close. They made thousands of these bets simultaneously, each one earning a small profit. But because they used so much leverage, those small profits became enormous. Confidence in the system was absolute. Risk, they believed, had been quantified and controlled. The computer said the strategy was sound. The models said the odds of significant loss were infinitesimal. 1 in a billion? 1 in a trillion? Numbers so small, they might as well be zero. In the summer of 1998, Russia defaulted on its debt. The government simply announced it would not pay what it owed. Markets panicked. The careful relationships between different bonds and derivatives shattered. Everything the models predicted became irrelevant. Prices moved in ways that the mathematics said were impossible. Long-term capital management began to collapse. In weeks, the fund lost billions. The borrowed money that had amplified profits on the way up now amplified losses on the way down. The fund was so large and so interconnected with other banks and institutions that its failure threatened to trigger a cascade of collapses across the global financial system. The Federal Reserve had to intervene. It organized a bailout. Major banks were forced to inject billions to prevent a catastrophe. The fund was dissolved. Its partners, the brilliant minds who had been so certain of their models, lost nearly everything, but the larger system survived, barely. What had happened? How had the smartest people in finance made such a catastrophic error? The answer was almost embarrassingly simple. They had believed their own story. They had trusted their models more than they trusted reality. They had assumed that because something had never happened in the past, it could never happen in the future. They had forgotten the oldest lesson of trading, that confidence becomes arrogance, that calm becomes complacency, that greed, dressed up in equations and Nobel Prizes, is still greed. These three stories, separated by centuries, share a common thread. In each case, people convinced themselves they had found a way to make money that was different from what came before, that this time was special, that this time the rules did not apply, and in each case, the belief in their own cleverness made them blind to the warning signs that were obvious in hindsight. The pattern repeats because human nature does not change. We are wired to see patterns even when none exist. We are wired to follow crowds even when the crowd is running toward a cliff. We are wired to believe that we are smarter than those who came before us, that we will be the ones who get out in time. Greed is not simply wanting more. Greed is the certainty that you deserve more, that the universe owes you a profit, that your bet will pay off because you made it. And this certainty makes people ignore, risk, dismiss warnings, and stay in the market long after they should have walked away. Trading, by its very nature, feeds this certainty. When you win, you feel brilliant, like you have figured something out and you want to do it again, but bigger. When you lose, you feel unlucky, like the market turned against you unfairly and you want to make it back. Either way, the pull is to keep trading, to stay in the game, to believe that the next trade will be the one that changes everything. This is why the disasters keep happening. Not because people fail to learn from history, though many do, but because the emotional drive to trade, to speculate, to seek fortune, is stronger than the rational understanding of risk. We tell ourselves we are different. We tell ourselves we will be careful. We tell ourselves we see the danger, and then we trade anyway. The technology changes. The markets change. The instruments become more sophisticated, but the human heart remains the same. The fear of missing out, the hope of getting rich, the denial when things start to go wrong, these forces have driven trading for centuries, and they will drive it for centuries more. There is a moment in every bubble, every mania, every market frenzy, when someone asks the dangerous question that breaks the spell. What if this is wrong? What if the price is not justified? What if there is no one left to buy? That moment is terrifying because it forces a reckoning and demands that people look honestly at what they have been doing. And most people cannot bear to look. They have too much invested, too much at stake, too much of their identity wrapped up in being right, so they dismiss the question, attack the person who asked it, double down on their position, and wait for the market to prove them correct. But the market does not care about their certainty or their need to be right. It does not care about anything. It simply reflects the collective decisions of everyone trading at that moment, and when enough people finally admit the truth, when enough people ask the dangerous question at the same time, the collapse comes, sudden, brutal, inevitable. The aftermath is always the same. Shock, outrage, demands for accountability, promises that it will never happen again. New regulations are written, new safeguards are put in place, and for a while people are cautious. They remember the pain, they remember the lesson. But memories fade, regulations are loosened or circumvented. New generations of traders enter the market with no personal experience of the last disaster. And slowly, quietly, the cycle begins again. A new asset, a new story, a new reason to believe that this time is different. This is not a condemnation of trading itself. Markets serve a vital function. They allocate capital. They allow businesses to raise money and grow. They enable people to manage risk and plan for the future. Trading at its best is a mechanism for price discovery, for finding the true value of things through the collective judgment of millions of participants. But trading at its worst becomes a game disconnected from value, a contest to see who can predict the crowd's next move, a race to sell to a greater fool before you become the fool yourself. And when trading reaches this point, when it becomes pure speculation, divorced from any underlying reality, disaster always follows. We cannot eliminate greed from human nature. We cannot make people stop wanting more. We cannot remove the thrill that comes from a successful trade or the agony that comes from a loss. These emotions are part of who we are and have been part of every society that has ever engaged in commerce. What we can do is remember that confidence is not the same as certainty. Remember that rising prices are not proof of wisdom. Remember that the crowd is often wrong. Remember that the words, "this time is different," have preceded every major market disaster in history. The tulip traders of Amsterdam thought they were different. The investors in the South Sea Company thought they were different. The partners of long-term capital management thought they were different. They were all wrong, not because they were stupid or reckless, but because they were human, because they wanted to believe, because greed, dressed up in logic and mathematics and collective enthusiasm, is still greed. The markets will crash again. Not tomorrow, not next year, but someday, because as long as humans are trading, the pattern will repeat. The confidence will build. The warnings will be ignored. The turning point will arrive. And once again, fortunes will vanish, lessons will be learned, promises will be made. And then, after enough time has passed, it will happen again. The trading floor is quiet now, but listen closely. You can hear them, the voices from the past, the merchants, the speculators, the traders, who were so certain, so confident, so wrong, calling out across the centuries with a warning we refuse to hear. That greed has always been part of trading, that it will always be part of trading, and that the price of forgetting this is paid not in money, but in ruin.